I want to start with inflation, not a recession, not wealth distribution. I just want to focus on inflation in isolation and not what it means for a recession. Can increasing interest rates really bring us down in inflation over the next 12 months? Neal, I kind of heard from you. The answer is yes, maybe not to the 2% that the Fed would like to see, but maybe to the 3 to 4%, which is by cutting it more than half of where we're at today. Bob, I kind of got some differing opinions from you a little bit. And what I'd really like to focus on are the supply side elements that impact inflation. We can control demand. The Fed can control demand by making it more difficult for the average consumer to buy things. But if CPI is mostly being pushed by food and energy, and the food is being dried up because of droughts around the world, supply logistics, because you can't get boats through the Mississippi River, the Yangtze River, or what have you, and 40% of Europe's energy was cut off through sanctions because of a Russian-Ukraine war, causing a global shock to energy prices. Can the Fed really stand up energy facilities? Can they just produce arable land through their policies? That's a question that I'd like to start with. I don't know who would like to go first, but can we really bring inflation down as a result of interest rates coming up in forever?
I think we look at the early 1980s because the Fed had a severe issue with oil-related inflation.
Right.
So right now we've got an energy inflation issue, and it's a worldwide issue. It's not actually the U.S. is the luckiest country in the world at this point, just for the record. So we are both an oil and natural gas producer. In together, if you take them together, we're the largest producer in the world. We're not the largest exporter in the world, but we are the largest producer in the world. And if you actually look at oil and gas prices today, we're pretty much the lowest in the world, with the exception of Saudi Arabia. So when you look at this, it's helpful to look at what the Fed was dealing with in 1990, late 70s, and also in 81. And basically, they used the interest rates as a brute force weapon. It is a hammer. It's not a scalpel. It's a hammer. And they bring down every single kind of demand by slowing the economy. And that also helps with oil. Sure, you could say, oil has nothing to do with us at this point of time. Food, is out of our control. But if you slow everything down in the economy, you slow down the amount of oil that is needed to run that economy, because oil is what runs our economy. Energy is the economy. And so this brute force weapon does work, will work. And I think what's happening now is that other parts of the world are beginning to follow suit. They really don't have much of a choice. So the Bank of England, even though England is in a historic recession, just cut interest or increase interest rates. The ECB is following. Everyone else is following as well. This works, but it really doesn't affect inflation. It affects the economy and pushes it down. And it's working. I mean, I'm looking at numbers right now. It's working.
So it affects demand side inflation, I think is what you're saying. And if the force of pushing demand down across the entire spectrum balances out more so than the supply side shocks that we're feeling internationally, we can get there. I think that's the argument you're making, Neal. So how susceptible is that plan to additional, let's say, higher likely black swan events in the geopolitical environment? If Taiwan is no longer able to give us more microchips, if Ecuador is not able to farm lithium for the Tesla batteries or what have you, because China becomes a little bit more aggressive with the Taiwan situation and some other hotspot areas in the world that produce resources that Americans consume, how susceptible is this kind of hammer or this amputation that's pushing demand side of inflation in working holistically to bring inflation down to where it's supposed to be?
I don't fully agree with that belief, and I'll tell you why. So that belief assumes that everyone is able to pay as prices go up. So I expect that we will see both oil and natural gas shocks in December, possibly January and February, even though I have to say the Eurozone's done better than I thought at hoarding natural gas, but I still see, short-term shocks. The honest answer, though, is America's only 18% of the world economy, and we may be able to afford oil if it spikes up to 160, 170 a barrel. But I can tell you this, the world doesn't have the money to pay for that level of supply shock. So let's say that there's a shock, and I'll go with oil first, and then we'll talk about China. You'll see prices spike up for 3, 4, 5, 6, 7, 8 weeks. And during that time, yes, inflation will go right back up. But then after that, it'll crush demand. It won't just drop demand, it crushes demand. So one of the key things that I keep reading about from lots of different economists is oil at 140, 150 or natural gas equivalent basically puts the entire world economy into a recession because there's people who simply stop consuming oil, right? We can't imagine that in our head. As Americans, we're so spoiled. We're like, I'll buy, a car that's, an electric car. I'll do something, but we're not basically going to change our lifestyles because oil goes up by $2 a gallon. But the other parts of the world, you actually see people simply not consuming other things, and those things include oil. So in the short term, I think Bob's correct. I mean, what Goldman's saying is basically we can have these supply shocks, and they can, they've been building up over 7 years of under investment. I get that. But when I'm looking at the next 6 to 12 months, if the price of oil is already pretty high, so it's in between $90 and $100 a barrel, once it starts going into the 120s, 130, 140, it just demolishes demands in other part of the world. And that part of the world is what pays for this, not the United States, because we get cheaper oil than the rest of the US, the rest of the world. Now, China, though, I mean, if China chooses to attack Taiwan, I think that is keep in mind that Russia's attack on Ukraine is going to look like nothing, because Russia's attack on Ukraine affects us obviously from an oil perspective and food perspective. Even though most of Ukraine's food goes to Africa and Europe, it still affects us in terms of inflation. It's an indirect effect. Attacking Taiwan is attacking the United States. I think from a geopolitical perspective, there is no way that we could withstand that. I think that China would be extraordinarily foolish to attack Taiwan. I think that all of this stuff that they're talking about is just Chinese internal politics. Please understand, the Russians can simply drive tanks into the Ukraine. There's roads between Russia and the Ukraine. There is the Strait of Taiwan that's 100 miles wide. And if the Chinese are stupid enough to actually drive ships across it, there's submarines, dozens of them, that the Taiwanese have that will simply sink the Chinese fleet. An attack on Taiwan is extraordinarily difficult. You can't find today a geopoliticist that will say that China will succeed at that. But assuming it happens, I think that's a far bigger event than Ukraine. And anything and everything that we say about inflation at this point, anything and everything that we say about interest rates at this point is completely off the table because no one even knows what will happen at that point.
Okay. So here's the question. Bob, I think this is more for you. Let's say that inflation does not tamper down. I think we're hearing maybe two different, slightly overlapping, but not quite the same opinions here. Hey, we can get the Fed down, or the interest rates down to the 3 to 4% range. Not ideal, but palatable. We can live in that world. And we have another opinion that's, we can probably get it down a little bit, but not quite to 3 to 4%. So, Bob, if you're in Powell's head, what is the flipping point that says, you know what, it's not working? Inflation's still above 5%. This isn't working. We're just going to back off because it's causing more harm than good. All right. So then let's talk about another hot topic. Let's kind of move away from inflation and how it affects, how interest rates affect cap rates. I think one of the most surprising things for everyone in our space is how little movement there has been in cap rates, despite interest rates doubling. Being in a negative leverage environment, being in essentially a negative spread environment. If you were to take the broad strokes, kind of nationwide averages in any asset class at this point, maybe not multifamily, but almost any other asset class, you would have to pay to be a sponsor in today's environment on average, just using market conditions, right? As opposed to, be paid for the work that you do. So let's talk about cap rates. Why haven't they expanded yet to the extent that they have?
To say I completely agree and completely disagree. So the part that I agree upon is the fact that there is astonishing amounts of capital on the sideline, and it seems that there's more capital now flooding into the US. It seems to be coming from the Eurozone. So I'm seeing that capital come in and saying, a significant portion of that will go in real estate because they're worried about the stock market being, where it is. So I'm seeing that impact. So I agree. And I also agree that even if inflation comes down, I don't expect it to come down to 2%, right? I expect it to come down to 3 or 4%. And the Fed basically at some point will make their peace with that. So we get this inflationary long-term benefit where values go up based on that. But my answer to you on why cap rates have not decompressed is actually much simpler. The answer is it's too early. Cap rates are about to decompress. In Q4, you will see cap rates finally decompress. in Q1, you will see an astonishing decompression. The reason for that is data. So, let's say Colliers is gathering data or CoStar is gathering data. The problem is there's so many states that basically don't disclose the sales price that it takes a long time for CoStar or everyone else to actually figure out what prices properties are selling for because they're not disclosing those, right? So, and more of the transactions are now happening in non-disclosure states like Texas. So that's where the money is, right? And they're not disclosing, so it takes a while to figure it out. So here's my argument. Cap rates have already decompressed. If you talk with the people that are on the front lines, the brokers, right? The brokers that are selling 10 assets a quarter, every single one of them will tell you cap rates have decompressed, but it's not showing up in the data. It's not in the CoStar data. It's not in the RD Matrix data. The reason for that is it takes time. Also, keep in mind how ridiculously quick this has happened, right? The Fed started raising rates in March, but that was just a quarter point. Who cares, right? But then the 0.75 hammers, 3 successive 0.75 hammers have just happened in the last 4 months. Well, how much property can you actually sell in the last 4 months? Almost everything that is in the cap rate data that we are looking at today was in contract before the 3 big 0.75 hammers. I would argue that the cap rate data that you're able to see today does not contain any impact from the 3 big hammers. That data could only start to be visible in Q4, and then it'll be highly visible in Q1. So you're going to see decompression happen in Q4, and then you're going to see massive decompression happen in Q1 as people figure out what properties they're selling for. There's already cap decompression happening.
So that's great commentary, and it kind of transitions into by how much, right? So like I've already seen 10 to 15%, driving acquisitions for Spartan. I've seen 10 to 15% price adjustments already. That's not the same as 100% rate increase. Right? Not only have we gone from 0 to 3 to 4 benchmarks for SOFR, but we're seeing spreads increase from 200 to 400%. I saw somebody post on LinkedIn, expect something as high as 800% spreads on SOFR, which would be a 12% interest rate. I guess that would be probably more for the high risk bridge stuff. So
Yep.
if rates are where they are today, you can assume 6.5 to 8.5, depending on what you're doing and how you're doing it. I mean, that is more than double what we were experiencing, especially multifamily 9 months ago. So by how much will cap rates expand, do we think? Knowing that they've only kind of expanded in my experience so far, 10 to 15% halfway into Q4.
I love that 10 to 15% number. I think that's what I'm seeing in the marketplace. I'll give you my rule of thumb, and I actually want Bob's kind of feel on this. So there's this myth that if interest rates go up by 1%, cap rates will go up by 1%. There's actually no data to ever support that. What I usually use as a rule of thumb, and this time it may be different, is if you see 100 basis point or 1% increase in the Fed funds rate, I'm not talking about mortgage rates, the Fed funds rate, cap rates will decompress by at least 0.25 to 0.33. So what that means is if the Fed funds rate's basically gone up by 300 basis points at this point, that's 0.75 increase in the cap rate minimum. It could be higher than that. So when the Fed goes all the way to where they're threatening to go, which is, basically 4.75 cap, and keep in mind that they didn't quite start at 0. I mean, and that cap rate decompression doesn't start for the first 100 basis points simply because that's too low. And so once the Fed got to a Fed funds rate of 1, you started seeing that cap decompression starts to occur. So if they get to 5, that's 400 basis points, which is basically a 1 cap difference. So but they won't stay at 5. My argument is they cannot stay at 5. They will not stay at 5. I feel like, Bob is thinking a little bit differently because he thinks inflation's very sticky. But if they stay at 5, let's assume for a moment they stay at 5, cap rates have to change by 1 cap. That's my math. Quarter point cap rate to 100 basis points.
And Bob, before you jump in, what is the theory behind that correlation from how you've assessed this in the past? Because that still gives you a 3-point negative spread, and commercial real estate typically has had about a 3-point spread between cap rates and interest rates.
3 points. Yep.
So how is that kind of what it is? It's like that works up until you've eliminated your spread down to 0, and then maybe it doesn't work so much. Is that the thought process, or how do you come up with a quarter point to 1 point relationship, or a third of a point to 1 point relationship? Neal, sorry, that was a follow-up question for you.
For me?
Yeah.
So,
yeah.
The answer is by doing Excel math, right? I've been simply doing Excel math of what the market will take. So for every increase in interest rate, there's people that are now basically willing to come into the marketplace because they are looking at the long-term asset. One of the key things is if you just look at that one-to-one relationship, you're saying, yeah, well, there's still, a negative correlation. I get that. But people are making bets on holding an asset for 5 to 10 years. And they're also making a bet that during some of those years, this correlation is not going to be as terrible as it is today. And so when they make that correlation, they make assumptions that the interest rate correlation will improve in their favor over a substantial amount of time. They're also going to make a correlation that if interest rates are this high, then inflation must be high. Well, if inflation is high, rent's highly correlated to that. So rents are going to be high. So I'm going to make money on that. So if you actually model out a property over 5 or 10 years, you'll notice that you never end up in a situation where 100 basis point increase in interest rates increases cap rates by 100 basis points. Because if you do that, model that out over another 100 basis point, another 100 basis point, you're either going to end up in a situation where no one in the world will ever buy multifamily, or everyone in the world will buy multifamily based on your assumptions. So neither one of those is possible. So I think that there has to be some correlation. So I basically model this out to the point where it's like, yeah, a quarter point decompression appears to occur every time 100 basis points go up in interest rates.
That was my intuition on what you were going to say, but I just wanted to hear you say it. So thanks, Neal. Bob, do you have a difference of opinion on, or the same opinion on where cap rates are going to go over the next 6 to 9 months?
One slight tweak to that, right? So firstly, I 100% agree. Class C is going to be hurt the most. Class A is going to be the most protected. 100% agree on that. I'm worried about core assets. The reason I'm worried about core assets is I'm not seeing employees come back to their jobs. I mean, I'm seeing still we're at 46, 47% swipe rate, those key swipes that people swipe when they go into offices. That's an extremely low rate. Pandemic's gone. And I'm worried about the number of people that want to pay extremely high rents in core assets. So I'm actually a little more bullish on assets that are a little bit further away from the core, but still looking at Class A assets. I think this is inversely correlated for anyone to be buying Class C at this point. Wait for a while. You're about to get lots of great deals on Class C. So just be patient. Just be patient.
So
Bob, my argument is if offices don't bring all of the jobs back, then the multifamily assets in that area are not going to see rent increases. They're probably not going to see rent drops. Obviously, this is core, right? But they may not see the rent increases that they're historically used to seeing.
And so just for the folks who are listening, when we're talking about Class A, Class B, Class C, are we talking about markets or asset quality right now? Secondary, tertiary markets, we're talking about asset quality of
a little bit about markets, but I think predominantly asset quality.
Awesome. Okay, so let's start taking some of the questions from the chat box here. And again, folks, if you are listening, you have a question, I'm looking at the chat, but it would be highly effective if you slap that question into the Q&A box. There are 2 different components on the bottom of your Zoom screen. One is a Q&A, one is a chat. The Q&A has 2 little message bubbles. If you'd like to ask a question, slap it into that Q&A box. So one of the questions that we have also from Brian is, which real estate sectors will get hurt or benefit from the interest rate increases the most, let's say. So let's maybe say, what's our top 3 real estate sectors that will be positively impacted, and what are our top 3 real estate sectors that will be negatively impacted?
Same exact ranking for all 3.
Same exact ranking. Okay, so I know you're both going to say office is the worst. What about second worst?
For me, it's Airbnb. Stay away from Airbnb. Those assets are insanely priced for today's marketplace. You're about to see, they were so ridiculously marginal when, people bought them in the last 2 or 3 years. People have been buying these properties for, $2 million, $2,000 a square foot. I think Airbnb is going to collapse. And not Airbnb, the company, I think they're doing fine. But the people that were basically doing short-term rentals, when you look at today's interest rates and what they were paying for short-term rentals in the last 18 months, it makes 0 sense. So anything in the short-term rental market, I think you're going to see incredible fire sales, and they will start quicker than fire sales that you might see in Class C assets because of what Bob was mentioning. SDR, I think you'll see plenty of bargains in the marketplace in Q1, Q2 next year.
Let's just throw retail out there for fun, because retail has been that one that, is it going to do okay? Is it going to bounce back? So I know that none of the 3 of us really invest that highly into retail, but what are you guys seeing out there in the retail space?
I've been investing in other people's strip mall type projects. and they've all done really, really well at this point in time. Now they can't sell them at this point because of 9 cap, right? But the cash flow is pretty strong. I mean, because of what happened in the last 18 months. So that they're all like, you know what? I'm cash flowing at 18%. Why the heck would I sell? I'll just wait for cap rates to adjust whenever they do. But for somebody to buy today at 9 cap, I mean, you cannot beat that. I don't think anything in multifamily would ever beat an 8.5 or 9 cap purchase in strip mall, retail. It's amazing.
I'm happy.